Okay, let me show you what I'm looking at here in Buffalo Wild Wings, BWLD. This was an earnings play, and it was a directional earnings play. Typically, an earnings play with a directional nature to it is not the best idea. Why? Because we don't have the report itself in front of us, right? Nobody does. So it can go either way. But the thing is, if I'm paid enough from a risk-reward standpoint, you can take a directional play. We're not going to take anything with undefined risks. We never do. But you can do it. And here's a setup of how to do it. Let me zoom in here. Okay, the first major thing that I'm looking at is this light blue bar. This is volume at price. So there's a huge volume, second only to the point of control, which is all the way down here at 95.21. Okay, so we have a big volume brick here that is acting as resistance. It was all this area in here, and then now it was actually coincident or just a little bit above the 50-day. So I have a technical reason that's giving me a ceiling over here that's giving me this resistance. So I can play off of that. We also, after back out a little bit here, so after this huge run up, we've now moved into a more sideways market up through here, up through the beginning part of 2014, and now we've actually started to move down. We have the Hull average moving down, we have the 50-day moving average moving down, and we have the Donchian channel moving down right here. Okay, so this is a possible reversal scenario. Makes it appropriate for a directional play, again, if we are paid properly for this risk. So you put together in this case, a put butterfly, 20, 25, 30 put butterfly. The way to think about this is all this is I'm long a put spread and I'm short a put spread. Think about it as financing my long put spread with a short put spread. Ideally, the best place to go for this is the 125 strike, because then my 25-30 put spread that I'm long maximizes, and my 20-25 put spread that I'm short goes out zero. So that's the best place to go. But we don't have to go to 125. In this case, we just have to go lower. Okay, so where am I looking at for potential exit points? First place here, this yellow shaded area in here is what's called the HVA, high value area. This is where 70% of the trades have taken place over the last year. So when you're above it, it acts as support. When you're below it, it acts as resistance. The next place that I was looking to potentially go was a volume strike. Let me pull out here a little bit. Basically, we sucked through all this volume. The next volume spike up here was like at 26.5. And then we have a congestion area here at 123. So those are the places that I was looking at. So 125 seems like a logical place for this to go and visit. So the earnings come out, and what happens? First, I cost average into this thing for about 32.5 cents. The earnings come out. They missed. Okay, obviously, started to come down here. It started to slow up here, right at this HVA, the top of the HVA. Like I said, it's either going to accept the prices into this HVA, and then it'll look for new places to find its support, or it's going to bounce off of it. I didn't want to run the risk of it bouncing off of here because, like I said, I bought it in for 32.5 cents. And I sold it out for 85 cents. I'll take my money off the table and not run the risk of this blowing up. So this is an example of how you can use a directional play into earnings with very low defined risk, defined money, capital outlay, and a very favorable reward to risk ratio.